Good morning, everybody. It is Friday, July 26th, 2016, and we got some GDP numbers today, and it is what I told you it would be. It's coming down pretty quickly. We got a 2.1% print. The outlook had been down at 1.8%, so the market's not reacting horribly because they actually beat expectations at 2.1%. And from here on out, we have to consider, is this the bottom, or is this the beginning of a choppy period, or is this a sign that things will get worse? And as I've discussed for about the last year, I believe that we are entering into a period of what I would call a skip straight recession, which means that we will have periodic bad quarters. And this quarter dropping down to 2.1% is not a bad quarter. It's not a horrible quarter. It's just a little less than what everybody's been being sold as a great economy. It's a good economy. It's not a great economy. And why is that? Because we have relied on financial engineering to get this done versus outright fiscal and investment policies and actions that would generate a more organic growth. What do I mean by that? We have been using quantitative easing and easy money to create as much investment as we could. However, most of that investment has been going into the secondary markets. That is the stock market, the bond market, versus into actual construction, redevelopment, things like that. So while we are seeing some of that around the country in particular, we are not seeing as much as we should. As I drive around the country, it is easy to see that there are still major parts of the country in every city that need redevelopment. So while we keep pumping up the stock market, the cities fall behind, even though you do have some development in the more desirable areas. You know, the areas that are more trendy, have more business, that are more gentrified. But as far as building from the middle out or the bottom up, it's not happening as far as I can see in the numbers or in just looking at what's going on city to city. I will be driving across the country again in August. I'll be driving around for little over 2 weeks, and we'll be going through Chicago and parts of Indiana and Ohio, Cleveland, parts of Pennsylvania, New York, Connecticut, New Hampshire, and a couple of other states we haven't decided yet. I probably will skip Beaver Falls this year. I think some of you remember that I went through Beaver Falls last year. The story on that is about in 2009, I drove through Beaver Falls with my kids, Pennsylvania, home of Joe Namath. Why did we do that? Because we blew a transmission line and we had to get towed somewhere. I went to Beaver Falls and saw how the steel mills and their manufacturing had pretty much deserted them. They were down to just a handful of companies. Buildings on the main street were boarded up. And it just seemed like one of those images where it faded to gray. And the whole area had faded to gray. There was no color left. There was no exuberance. People walked around with their head down, and there weren't many people walking around. The town had lost a lot of its population. Flash forward to next year, or last year, so 2018, I drove through there on my way back from the East Coast in August, and was surprised to see that not a lot had changed despite the huge economic recovery in the country. Again, when states like Pennsylvania, Wisconsin, and Michigan voted for Donald Trump, it was largely because A lot of people felt left behind and desperate and disrespected by government. And when I saw that after 9 years of recovery, Beaver Falls still had a gray cloud over it, the only new buildings that I could pick out were a low-income housing project, a Medicaid nursing home, and a social services building. It makes you think, maybe we're not allocating resources very well. And with all the money freed up through the monetary system, how is that not finding its way into, areas that are an hour outside of Pittsburgh and beautiful? I mean, Beaver Falls is beautiful, the surrounding area, and it's close to major cities, a couple hours to Cleveland, an hour to Pittsburgh. Why can't areas like that recover? In an era where we have a gig economy and you don't really have to be anywhere in particular for an awful lot of jobs now. So I'll be looking for those signs again as I drive through the country. Are we really seeing redevelopment and investment into our communities, into the local businesses, or is everybody just trying to skim the markets? And if a lot of people are just trying to skim the markets, then we have to ask ourselves a question: is there more upside right now or more downside right now? And I think that it's clear to me that at a minimum, those two things are roughly equal. And we might be getting to the point, and especially if the market rallies here one more time, and it can, my original prediction for the ultimate end of the stock market rally based on quantitative and technical factors was somewhere in that 3,500 to 4,000 range. I could see us sniffing 4,000. 3,500 made a lot of sense, but rallies often go further than they should. Avi Gilbert over at FA Trader, where I contribute, has been saying the same thing. I think his range on the upside of the S&P is like 36 something to 4,000, and like just over 4,000. So we didn't really know each other a few years ago, other than I'd read some of his stuff on MarketWatch and he read some of my stuff on MarketWatch. But we came up with similar answers to the top side of the market based on slightly different, fairly significantly different approaches. He uses Elliott Wave. I use more quantitative factors and money flows, but they both look similar in the end. And that makes sense because the sentiment of the markets ultimately is somewhat related, largely related to what is really going on. And technical sentiment, all those things are relatively similar. Quantitative is just the numbers underlying. So let's suppose we get a rally up to 35, 3,600 on the S&P 500 in the next year or so, or even 4,000. What would that mean at that point? Well, if we dial that back to economic expectations, we would expect that we were getting a rip-roaring economy to see that big of a rally in the stock market here towards what everybody thinks is around the end of the bull market. What if we don't get that growth? What if the market rallies on irrational exuberance, for lack of a better term? I'll give Greenspan that one as his contribution to the lexicon. What if companies don't become more profitable in the next year, and in fact their profits slip a little bit? What if there is no trade deal? What if this 2.1% print, which beat the 1.8% expectation, is just the consumer having a great summer? And that's what I think it is. I think consumers are spending money, having a good time, but I think if you talk to people and you hang out as much as I do, you will find that in the back of people's mind, they're worried about what's coming. And I think that they're worried because they're seeing what's going on in a lot of workplaces where, as I've told you, we need to watch for unemployment numbers to go up. A lot of companies are starting to squeeze a little bit on employment. They don't want to pay the higher wages that people are trying to get. They don't want to train the lower qualified employees that are left in the pool. And they're trying to squeeze profits out. I've been studying a lot of companies, in particular the REITs, for about the last 6 months. And I will tell you, not only do the REITs have real estate risk, but they're trying to wring out more money to pass through the shareholders. And they're doing it through, trying to control their labor costs. And if anybody's been paying attention the last 40 years, labor costs really have not gone up that much. Really just in line with inflation, which we know is super low. So I think that the warning signs are there that we need to watch. That doesn't mean that the stock market can't rally again here once quantitative tightening is over in September. That $50 billion a month that will no longer be coming out of the economy is a big deal. So what really concerns me, same thing that concerns everybody else, the trade war is starting to take a toll on China's economy and on ours. And as we've talked about a dozen times now, probably, the Chinese can afford to play the long game because none of the people in the Chinese government are going to lose their jobs. President Trump, on the other hand, has a much more difficult time this time to get elected than he did last time. And the last time, it took him to thread 4 needles. So will he be able to thread those 4 needles again? Not if the economy softens up. I just don't see it even being possible. And even with the economy as it currently stands, I think it will be difficult for him. As I've said, I think he probably loses or he loses badly. I'm not really sure which one. But the odds of him winning, given where the approval ratings stand, given where the economy stands, given what the pivot points are, mean that we should be aware of what happens if he does lose. He has the power of incumbency, and that's a big deal. And there are several states that Hillary Clinton won very narrowly. So, depending on who the Democrats run, maybe he flips some of those states this time. Who knows? But we need to be aware of what's going on with economic growth and how tough the trade war is on things, even though we're not quite feeling it in our houses yet. But it's getting close. They're feeling it in China. And as I said, China might be willing to put some pressure on us. What does Larry Kudlow say? I wouldn't expect any grand deal on China. What did we talk about way back in February and March and April? Would it be a no deal or a fake deal? And I think that's where we're at. Will we get some marginal deal that gives the Chinese what they need, right, to hold off on a bigger deal? Or will President Trump take a hard line? I suspect that there's no deal and that President Trump blames the Chinese for no deal. And if there's no deal, that is something for President Trump to run on because he'll say the economy softening is the Chinese fault, not my fault. So I would expect that to come. I would expect a softer economy. I would expect no Chinese deal. And I would expect the line from the Trump campaign to be everything would be great if the Chinese would just play fair and the Fed would just flood the money flood the system with money. So we'll see how that plays out. I'll lay that out in an article. But I think the economy is going to continue to soften. And I think quarter one of next year, because the first quarter has typically been the softest quarter, I think we could actually see a very slightly negative first quarter next year. Not negative 3% or anything, but like negative 0.2%, right? Just enough to have a negative print that they can't fudge upwards somehow. Because they can fudge these numbers by, almost up to a point. And then they revise them in the other direction a quarter or 2 quarters out when they have better data, right? So, they can fudge up to a point. So what if we see a 0.6% GDP number in Q1 and then they revise it down to negative 0.2, whatever. But that's the sort of thing that I expect in the first quarter. But I do expect a bit of a rally here after QT ends. So Q4, I think, looks pretty good because we are having a positive year. And usually the end of the year reflects what the balance of the year has been. So in a down year, the fourth quarter gets worse. And in an up year, the fourth quarter does pretty good. And this is a year where I would see the fourth quarter doing pretty good, especially with the $50 billion a month hitting the economy, or not coming out of the economy because of quantitative tightening, right? The end of quantitative tightening adds $150 billion in the fourth quarter. And $150 billion in the first quarter that doesn't come out. So at what point does the Federal Reserve get even looser with money? Do they go down towards zero interest rates again? We'll see. I think by the time they do that next year, it might be too late. We might already be in that skip straight recession where we have a negative first and third quarter or something. Could we get back-to-back negative quarters? We could. But it's tough for the United States to have back-to-back negative quarters. There's just so much consumer spending that needs to get done that for people to voluntarily tighten their belts more than for a few months at a time is unusual. It usually only happens when unemployment goes up. So again, we need to keep an eye on those unemployment numbers. And for now, they're good enough. We need to see around 200,000 jobs per month created. We've been hanging around that number. But once that drops, and especially as unemployment, as layoffs pick up, those are some numbers that we should keep an eye on as the layoff numbers. So I don't want to paint a crisis image here, but general softening in the economy, how does that impact the profit margins of companies? Well, if you take a look at Amazon, they sold more things, but their profit margin dropped again from, I think, around 7% to around 4.5%. That's probably going to go on all over the place. So while Amazon's warehouses are largely automated, they're still hiring lots of people. That's more labor expenses for them. And they're trying to streamline, they're changing the way that the Amazon marketplace works. And I suspect that it'll work out for them. But is Amazon really one of my big growth companies anymore? Only because the cloud, I would say yes, but just barely. I'm much more like Alibaba. They have a much bigger cloud to expand into in Southeast Asia than what's going on here in America. And of course, Amazon is competing with Microsoft and now Google and now IBM for a lot of that cloud. We'll see how much of a growth juggernaut Amazon is going forward. The fact that they've gotten into the grocery business, I think, is a huge gamble. I think it works out for them. Whole Foods is a great place to shop, but it's a big technology investment, what they're trying to do. And you have to wonder, is automating grocery stores really going to improve grocery profit margins? versus hiring 17-year-olds to bag your groceries and check you out? I don't know. We'll see. So where is the growth in the world going to be? Let's talk about some companies. I had some questions, and then we're gonna finish off with gold. But where is growth in the future? We need to start paying attention to Africa. The investments there have done pretty well, and most folks in the West have no idea what's going on there. I have to admit, I've only kept a cursory look at Africa, but for our asset allocations, we may need to start adding a slice on pullbacks. And pullbacks in frontier and emerging markets are worse than in developed markets, at least historically. I'm not so sure that's going to be true going forward. Somebody mentioned Kyle Bass in the chat. Kyle Bass is a smart dude. He's early on a lot of stuff. He's been talking about China and Japan for the better part of a decade, and nothing horrible has happened in either place. But he's usually got the big picture right, and it's just a matter of when does a market become rational, right? Markets can be irrational for a very long time. Eventually, what makes sense and what the numbers support happens. At some point, you can't conjure up money if it's not coordinated with everybody else in the world, right? Eventually, I do think we get helicopter money, but I don't think it's until the United States is ready to do it, which probably isn't for about a decade, when the baby boomer bust occurs. Where else is there going to be growth? Well, take a look at what SoftBank is doing. Another vision fund focused on, well, they had a chart. Did I miss it? Maybe they just listed it. Focusing on technology. So, let's see here. Find AI. There we go. Maybe I had to listen to this. Maybe that's where it was. Well, here we go. The AI revolution is what they're investing in. We took a look at that chart from ARK Investments. This is largely what SoftBank is going and their partners are going to invest in, right? And in particular over here, the green areas. Where is the overlap with energy storage, autonomous vehicles, biotech, things like that? But this is really where the money is going to flow to in the next decade. It's already happening. Blockchain technology, people think cryptocurrency. That's not what it's mainly going to be for. It's going to be for tracking data and transactions in various industries. Here's an example. The oil and gas industry is using blockchain technology to transfer data, to monitor wells, and to monitor trading of energy, right? So we've been talking about biotech for 20 years now. That'll just keep going as personalized medicine eventually develops. Artificial intelligence, machine learning, robotics, energy storage, alternative energy. This is where the big money is going to be in the next decade. And we not only have to find the small companies that are involved, but the big companies that are transitioning. And what do we know about transitioning companies? They get beat up once in a while, and then they come roaring back. So if we can find companies in the midst of a transition that are going to come roaring back in a year or two, we want to be aware of that. Could a company like GE be one of those companies? I think so. They have to jettison their power units and a couple other things. But once they finally clean up that company, 2-3 years from now, GE could be a good investment again. Do I think it gets beat up one more time along with the market? Yeah, maybe. But, maybe we buy GE soon. We'll see. I'm not sure that they're going to succeed, but they're definitely in this space and in this space and this space. I mean, they're everywhere here. But they just have some bad legacy units and huge debt and huge pension obligations. So we have to see what type of strategic transactions they do. Quick take a look at the T-Mobile merger with Sprint. That's going to go through. They are selling off assets to Dish Network so that Dish Network can become the fourth telecom. For Dish Network to become the fourth telecom, not only do they need the broadband and the infrastructure that they're buying, but they'll probably have to buy a significant wireless carrier. To my mind, U.S. Cellular in the center of the country is the best cellular company for Dish to buy to make it a backbone of their 5G network that they're going to have to build. And there are other regional companies on both coasts. So we should see some amazing strategic transactions. I don't know how that plays out because some of these mergers, which is what some of them will be to pad the pockets of the executives and create some smoke and mirrors for the shareholders. Basically saying, look at what this growth can be, but then slow playing what the expenses will be. But let's keep an eye on that. I think the Sprint T-Mobile merger is a good one. The money, the $5 billion they're getting from Dish will go, into their building project and maintaining their debts at reasonable levels. T-Mobile was in good shape there. Sprint was in bad shape. We'll take a look at whether or not we should be buying some Sprint. I don't know if there's an arbitrage deal there or not. We looked at it a while back, so we'll look at it again. Somebody asked about Tesla. I'll just give you my take on Tesla. Anytime anything changes at Tesla, the bears go crazy, right? And they beat up the stock. So Tesla's earnings that just came out weren't quite as good as some people hoped, but what they're missing is that the company's liquidity problems really are gone. The tightening of the belt that they did when Elon Musk said hey, we only have money for about another year, has really been pushed out another year. So they have alleviated their short-term financial problems. The company is selling more and more cars, the Model 3s. And I would look at the Model 3 the same way that you look at a 3 Series BMW, right? Not everybody's going to have one, but the people who do will pay for it. And it'll be a profitable car. Their margins are still around 20%. So while their margin dropped a couple points, what we have to keep in mind is that the way that technology curve is working. The technology curve is bringing the costs of those cars down faster than they're going to lower the price. So if the cost of a Tesla drops 10%, so that would be about $5,000 because the average Model 3 is selling for $50,000. If the cost of that car drops $5,000, right? Well, actually, we should say, since they're making some money on it, $4,000. But they only lowered the price $3,000, right? Their profit margin will go up. So the costs of the car are going to go down faster than the price of the car. And at some point, the new batteries that they introduce in 2 or 3 years, which I told you about before it became news, right? I was talking about the new batteries that they were going to introduce 6 months before anybody realized that they were going to do it. And then Tesla announced they were going to do it, right? If you're reading up on these companies and you're trying to figure out, why did they distance themselves from Panasonic? How does this coincide with some of the zinc and lithium air announcements that have been out there? How does this coincide with the federal government and the Pentagon releasing battery technology, right? So the cost of a Tesla Model 3 probably really is in that 35 to 40,000 range 2-3 years from now, rather than 50, which is really what you're paying. They say 35 is the base, but the average price is still 50. So when the average price is 40, what does that do for that marketplace? It means that they probably dominate the introductory luxury space. What about 5 or 6 years after that, when everybody else has finally got their EVs in the market, but they have the Model 3 down at 34,000, 33,000, basically the cost of a Camry right now, right? They kill that market. I'm not worried about Tesla being able to sell cars. The people who say they're too expensive, they're too expensive for some people now, but the cost of the car is coming down dramatically, and new battery technology will make those prices come down even further. Moore's law is in effect, at least for now, and then at some point, their first mover advantage is big enough. They just keep on eating into other companies' market shares, because nobody else really has a great fleet of EVs yet. Volvo, Toyota, BMW, all going to compete, but they'll do much better on their home markets than they will anywhere else. The status symbol of a BMW is much lower today now that Tesla is in the market. People will buy a Tesla versus a BMW in many, many cases. So J.B. Straubel left the company, and everybody jumped up and down. This is the iconic picture of him pasting together some solar cells. And or actually batteries, take that back, batteries. When inventors leave a company, when the big time engineers leave a company, and you can go back to the tech companies, the car companies, anything out there. When a guy like this leaves a company, it doesn't mean that he's fed up. It doesn't mean that he doesn't see a future. Usually what it means is the job's mostly done, I can hand it off now. And that's where they're at. This guy helps get this company off the ground. They're off the ground. Once China comes online sometime early next year, they talk about late next year, but come on, we know how Tesla timelines work. It won't be late this year. It'll be, first half of next year. When guys like this leave to recharge, but they agree to stay on as an advisor, that's usually a sign of good things, not of bad things. So I would keep that in mind. I hope everybody read the article on the asset allocation, why we did a little selling here in June, July, and the ETFs we plan to add to our asset allocation, and then the sustainable growth stocks, which we are going to be adding. Several of the stocks that we're going to buy are on this list in the ARK holdings. I'm not going to tip you off too much, but obviously Tesla is a company that I think is going to do well. Somebody asked, is 220-ish a good buy price? I have consistently said that you buy Tesla when it gets under 200, and I'll stick with that. It's a volatile enough stock that you can try to get it under 200. We've looked at 150, 60, 70, 80. That's been the range. It doesn't look like it'll get down to 150 again, but you never know if the economy slows and they have a bad quarter and China gets pushed out 3 months, which it will. So be patient, wait for it to get under 200, then buy yourself some shares. It might be the next time it goes under 200, triple bottom, it might be the last time. And I want to finish up with gold. Remember last week we talked about alligator arms. when lines like this get really far apart. What is this line and why do these lines matter? Because we can draw any lines, but why does this one matter? Well, this is gold versus the price of gold miners. So gold came down. We can even look at a longer chart, right? Gold miners shot up as price of gold started to go up. Price of gold started to go up. And now all of a sudden the gold miners are closing that gap. It's kind of similar, huh? I would expect the gold miners to do pretty good as gold chops along, but on a drift upwards. Why? Why will gold drift upwards? Demand is steady to slightly increasing, not because we're going to go to a gold standard on money. That will never, ever happen. Never. Not in anybody's lifetime. It's not even worth talking about. The people who talk about it are knuckleheads trying to convince other knuckleheads to buy their knucklehead stuff. But the gold miners are controlling the price of the development of gold right now. Why? Because there's been huge consolidation. Newmont and Goldcorp merged. Barrick merged or bought Rand Gold, just bought somebody else, and they've bought a bunch of little players. Massive consolidation in a space, especially in commodities, usually leads to higher commodity prices. The gold miners, which have a relatively fixed cost of development of around $900 to $1,100 per ounce, and they're probably closer to 900 now, but the price of development will go up a little bit as they try to find more. But they're very leveraged to that increase in the price of gold. So if the price of gold goes up to say 1,600 by next year, which I think is very possible, and their cost remains around $900 per ounce, that's $300 more per ounce drop into their bottom lines. So the leverage for the producers is very good, and they can control that for years and years and years now. We have effectively seen an oligopoly develop in gold production, and that's going to make those companies very profitable so long as there's no crash in the price of gold. And the odds of a crash in the price of gold at this point is pretty slim. The blue line here is gold. It's a good consolidation for a long period of time. So probably pretty safe there. Newmont Goldcorp, the green line. Gold miners ETF, the orange line. And then Barrick Gold, the red line. So I think over the next couple of years, we're going to see Newmont do very good. Barrick still has more financial issues than Newmont. Newmont's, I think, the best shirt in the batch there. They just had a bad quarter on not even a bad quarter. The synergies that they're expecting are just coming along a little slower from the merger, and they had some expenses with the merger. This little pullback in Newmont, I think it's at about 37 right now. You can start nibbling on Newmont pretty soon. I think 36, 35, 34 are all really good prices. Newmont could go back up to its highs pretty easily. Let's just get rid of this stuff. Newmont could pretty easily get back up to here. Could it blast through? I actually think, like I believe with AT&T over the next several years, I think that they can create a new range at a higher level because they have fixed their balance sheet and the makeup of the company, what they're spending money on, what their projects are. They've just done a very good job of redefining what the company is. So for them to go on a rally all the way up into the 40s and 50s, I think is pretty easy. And then can they let's see here. That's the one I wanted. Can they get up into the 70s and 80s? Eventually, yes, I think they can. Unless there's, like I said, unless there's a reason for gold to crash, which I just don't see anytime soon. In fact, I see a very long-term rally in gold. Very long-term rally in gold. Maybe for the better part of a decade. So I think that these gold investments, and I'm not a gold bug, right? I mean, you've read my articles. I told people to get out of gold years ago, and this is the first time I'm back. Starting last year, we started nibbling in, but Newmont was the big purchase. The other company that we bought was a company that redeveloped themselves a junior, and I bought this junior. My average cost basis with put premium is right around 5. So I'm a little underwater on core, but you'll see they've come off this bottom. And if we take a look at the technical chart, this is the weekly. You can see that they bottomed about a year ago, and money's been drifting in. So all those pullbacks are worth buying. Newmont, look at that. Money flows keep drifting in week over week. So when you get several days where it falls off, where you get that 2-week period where it falls off, just consider that the weekly trend, week over week after week, has been up. People are putting money into this stock. It almost was overbought, came back down. I think that it's worth buying here shortly. Maybe it drops a little bit more. But mid 30s is a pretty good buy price here. The merger price after this special dividend was what, 31, 32, 30, something right in there. So these are pretty solid prices to buy. I like these gold stocks quite a bit. All right. Let's see if we got any quick questions. What's your perspective of interest rate increases in the future? We're going to, and I've been saying the same thing for, gee whiz, now 6, 7, 8 years. We're going to have below average interest rates until the 2030s sometime, maybe even the 2040s, but for sure into the 2030s. So the odds of interest rate increases being a big deal, they won't be. Could we get cyclical runs for a year or two where they raise interest rates 2 points? Sure, it could happen. It's not going to happen in the next year or two. Interest rates are coming down. Quantitative tightening is ending. If we get a recession next year, bet your bottom dollar they'll do quantitative easing or go back to zero interest rates. So if the bond market reflects higher interest rates, then we might even want to buy TLT because zero interest rates on the short term and the 20-year coming down to under 2 are both pretty likely at some point. There's just not much point in trading it. The time we should have bought treasuries was a year ago, but we also know that international buyers only want to buy treasuries when they think there's a crisis or an economic problem. So it's an ebb and flow, right? You have to trade bonds just like you have to trade certain stocks. In fact, I would argue that you need to trade bonds more at low interest rates, right? Because who gives a crap about a 2% or 3% coupon? ECB announced rate cuts, right? The Fed will probably follow the ECB, absolutely. So on the SPY puts, I have S&P 500 puts for October. Not a lot of them. The main thing that we did was accumulate cash, right? People who trade bonds or trade options better be good at it, right? So we have high percentages of cash right now, and I just raised the cash percentage here. So in fact, we have to update the moderate and conservative as well. We brought, for aggressive traders, we brought the cash up to 60%. And so that means that the moderates should also be at 60%. But the fact that they're all basically the same now at 60, 60, and 65, it's not because their risk tolerance is the same. It's because they trade differently. The aggressive investors tend to trade more. So they'll have a wider range of cash. Whereas the moderate and conservative investors, they're just waiting for, easier opportunities, for more easy to handle fastballs rather than tough to hit hard sliders. So as a tactical move, the aggressive investors went as heavy in cash as the moderates and the conservatives, right? But that won't last long. When I have time, everything on both sites will be the same, whether it's fundamental trends or seeking alpha. So we talked about this in an article. GDX. Take a look at the weekly chart. Money flows are in. But in the very short term, it looks like it might be turning over just a little bit. I think the mid-20s is a good buy price for GDX. I have my limit order set at $24. Doesn't mean that you can't buy a little at 26 and 25, right? I think this is going to double in the next several years, right? So if you get too nitpicky about where you're buying, you might miss it. So buy a little bit on a down day and then wait for another 10% drop, and then you maybe buy more. Then if there's another 10% drop, you buy more. Don't buy because it drops 2%, back-to-back days. Spread out your buy prices by 10 to 15%. That's how you scale in. But we're close, right? We just came off of these levels. This isn't a big difference here. And should it really come all the way back down to 24? I think so, because the markets do seem to wiggle a lot more when they wiggle. They don't wiggle as often, but when they wiggle a lot, right? So I'm shooting for 24. We'll see if that happens intraday at some point. So when I set these limit orders, I don't sit there and wait with my hand on the trigger finger. It's a limit order. I do other stuff. But I think mid-20s is a good buy price. Just a pullback. Even see right here, 26 and a quarter, 26. It's probably a decent price. Is Boeing in longer term trouble? I think we have to see how that plays out because they're going to start getting sued now by airlines. I don't know how low Boeing can go. What's our bottom fishing price on that? So was our bottom fishing price around 275? If somebody wants to take a quick look. Or is that a support level, 275? Yeah, somebody take a look at the VSL and let me know. I don't think Boeing is a growth juggernaut. I last bought Boeing back in 2014, and I sold it in here. So all of this in here, look at that sideways trend. they're pretty fully valued as far as I'm concerned. You know, can you trade around it? Sure. Do I think they're going out of business? No. Yeah, Boeing's a big important company, and they could even do some divestitures themselves. So I don't have any huge fears for Boeing. But would I buy them up here? No. They're at the top of their S curve. You know, it's a mature company. There's nothing exciting about Boeing. If you were a good trader and you wanted to trade all that stuff, have at it. It's not something I want to do. The Micron calls, I think that you can probably take your profits on. You're probably way up on those. And the Nutrien call, maybe I've trimmed some of the Nutrien calls already because when they got up to what, 53, 54. But I didn't really recommend Nutrien calls either. You know, I told folks that it's a dividend stock. You just hold it for a long time. Yeah, I'd have to go back. I don't think I got like just a couple of these on the books yet. So I think, well, they got to 53, 54. That was that. I'd have to take a look too. I don't know that we've ever specifically said to buy Nutrien calls. I did it. I mentioned it. I don't know if I ever put it in an article. Yeah. I don't know where you got an official recommendation for that, to be honest with you. All right. Should I sell my CD? No. Core could go up to 20, man. I think that GDX and Newmont, I've got all three, or I'm going to have all three. I don't have GDX yet. But I'm going to add that to the global trends, right? It's in the asset allocation. Newmont I own, CDE I own. You know, I think we should probably look at selling puts on GDX, right? That's probably a good one for folks who sell puts. Who gets hurt by Intel's sale of smart chip? Nobody gets hurt. Apple wants to develop their own chips, their own modem chips, so they don't have to buy them from Qualcomm. It'll take them 2 or 3 years to make that happen. So Qualcomm ultimately loses Apple's business. So when you talk about Qualcomm, try to figure out how they are doing in 2 or 3 years without Apple's business. Because eventually Apple's going to take the business from them. They just have a short-term deal with them right now. So, you know, that's going to be a lot of business that Qualcomm loses. So if there is a loser, eventually it's Qualcomm. Right? So if we take a look at Qualcomm here. There you go. 75. I mean, they're not quite at their highs, but when they were having their little spat with Apple, this is where they were in, right? This is the range they were in. So what is that? 60. So I think Qualcomm is going to see $60 a share again. You know, if you're just collecting the dividend, I mean, I don't know why 3.29% would excite you that much if you know that you're probably going to lose 20% here. That's 6 years worth of dividends. So Qualcomm eventually gets down to around 60 again. The bottom fish price. Yeah, okay, so that makes sense. So with Boeing going back, somebody looked at, yeah, the bottom fishing price was just over that 175 level. So, yeah. So this makes sense. Right above this level here is the bottom fishing price for Boeing. so 200-ish. Then I'm guessing that the support price what's the support price then? 275, 280? So again, if you don't think that Boeing can drop all the way down to these levels, right, that's a long way down. If it breaks through here, it's a long drop down. Can that happen? Absolutely, it can happen. It can drop down towards 200. Will it? I don't know. Like I said, I'm just not excited because I don't think there's much upside to these guys. Could they go back to their highs? Yeah, sure. And if you catch a run from 300 something to 400 something, probably take your profits. But that's just a trade. I don't look at Boeing as an investment anymore. It's too mature for me. And it's not that stable. I mean, there's a huge drop here that they could experience during a recession. All right. We're at an hour mark. Let's call it a day. This is 6 weeks.